Hello, folks, and welcome back. My apologies for taking this quick break, but I had some stuff going on, and I was taking a rest. I hope everyone is doing good. And today we have a Nasdaq chart, and then a quick, brief explanation on what's actually going on and why I think, or for once, I'm gonna trade Nas over any forex market, or I was planning to do so at least before the week even started, right? So I had a discussion with a student of mine, which is Arman, about the Nas chart, which I didn't even pay attention to, and I didn't even realize how good it looks in the first place. But after that discussion, I just realized how free it seems. Now, the term free either goes to bias or goes to entry. Most of the time, I refer to bias because if I have a set bias that is simply determined by my own system, then the only thing I need to worry about is my positioning, my entry, my exit, trade management, risk management, and so on, which means it's less stress. And again, uh, less stress means more capital. So here, this is the Nasdaq chart, and I would like to discuss the higher time frame before going to the lower time frame from the time the yearly candle opened up until now. So, if you remember, at the time the previous yearly candle closed, right? We mentioned balanced price areas, we mentioned imbalanced price areas, we mentioned gaps being filled, we mentioned down close candles acting as ranges, we mentioned bullish order flow, we mentioned higher prices, and so on. The opened discussion was is the current candle or was if the current candle going to be an expansion candle or going to be classic trendy candle or going to be a rangy followed by expansion candle. That was the only discussion. Beside that, the candle's bullishness was quote unquote no doubt. Since we discussed and we read order flow in every single higher time frame quote unquote candle range, and it was clearly shown that order flow is bullish. So if order flow is bullish, it's gonna be backed up by what? Highs and lows. If lows are being rejected and highs are being broken, it's gonna be backed up by what? PD rays. If PD rays, bullish PD rays are being respected and bearish PD rays are being disrespected, the entry method or knowing the exact candle to enter on is following the candle closure system. Close above higher prices, close below lower prices, vice versa in a bullish market. So the reason it's designed this way, and the reason it starts with order flow and it ends with candle closures, not the opposite, and it cannot take any other term, we determine order flow by the three last tools I mentioned. But if you determine order flow first, then you're gonna answer all three questions that comes next easily. For example, let's say you try and read order flow here, and then if you read it only by using a 5 candle look back, then the key candle you're gonna use is this one. So a down close candle in a bullish market being engulfed, a fake CSD into a higher time frame inefficiency, aka inefficiency created, filled, aka retracements are happening to the downside, so expansions slash trends are happening to the downside, aka higher prices. Down close candles are order blocks supporting price to the upside, right, or pushing price to the upside. Expanding, aka closing above higher prices, closing above higher prices. Until a candle fails, then there is an open discussion of reversals if we range in premium, open discussion of a retracement if there is gaps found on discount, and so on. And then if you jump, or if you read order flow correctly and you jump into highs and lows in a lesser time frame, such as the quarterly or so, then the specific idea that you're using within this chart is and going to be as follows. You're using highs and lows before PD raise because you're simply looking at it as a game of highs and lows and not a game of nothing else. You're prioritizing highs and lows due to a foundation of liquidity pools within them, due to justifying retracements because of them, justifying explosions and expansions because of them, and it's all liquidity based, as we discussed before. So the idea is for a PD ray to work in the first place, and for you to count on a PD ray in a non-expansion chart, and when you're now buying in premium in a simple sell side buy side chart, then the main thing you're watching really is where the last low is rejected and where the last high was broken, aka the last daily range that was formed. On that case, you're using this specific dealing range as a potential idea to find what the number 3, which is PD arrays, right? And then you're backing in, or then you back it up with candle closures, quote unquote concept. So here you read order flow correctly, and the only tool you need among the four is candle closures. You read order flow, number one, and then you read PD arrays, since there's an absence of highs and lows, since it's an expansion chart. Bullish PD arrays are being created and also respected. And then eventually, close and above means higher prices, expansion chart, which means you're buying blindly on premium, expecting a bullish candle if the previous candle succeeded at close and above. And then any lesser time frame, right, is gonna use all four tools, right? So whether you read order flow when it comes to highs and lows, then retracements are to the downside, failure swings are lows, right? Or you read, or and then highs are broken, or you read FV, or you read PD raise, bullish PD raise created and respected, essentially a bullish order flow. And you want to read candle closures, then down close candles are ranges, rejected, broken, retested, rejected, broken, potentially retested, and so on. So at the time the yearly candle opened, alright, you had the quarterly candle, number one, and the idea is, as we discussed the seasonal tendencies in the beginning of this year, it was clear as day that there will be a dip at the open of the candle, even if it's an expansion candle. Now a dip into a gap, a higher gap, an old range, an old high. The only fixed value that you know is that the failure swing that was formed, quote unquote failure swing, in a lesser time frame, it's a false dip before a breakout, right? Is never being reached if higher prices. We're shifting below this if it's reached. So think about this leg here as a breakout leg, and then a retest, a simple retail logic, a retest of an old high, right? So sell side, then buy side, then retesting both, quote unquote, balance price area, just like you do with a breaker, and then another leg. So if we ever move towards here, we're disrespecting what? The idea of higher prices from bullish key levels. We're disrespecting a down close candle in a bullish market. We're disrespecting gaps in bullish markets, which means non-willingness to refill gaps before moving back to buy side, right? Which means we're not retracing, we're expanding, we're retracing, or we're disrespecting and looking for lows to be broken, and we're looking for highs to be rejected, aka bearish order flow. So at the time Q1 prints towards the gap, right? We shift the lower time frame, and the only way you read the lower time frame shift as bullish, sorry, the only way you read the lower time frame shift to the downside as bullish, if it's a lower time frame shift into a higher time frame key level. Now, what convinces you more is the shift is also a higher time frame CSD, correct? Now, the structure is either selling more towards the gap or a candle of a bottom inside this gap, then higher prices, and no in between. Right? So you're either using the gap with Q1, so a timed range being a down close candle in a bullish market, a candle range and a timed range and a discount array below, and then Q2 below Q1, and then a balanced price area with an imbalanced price area, a high probability level, to then eventually buy to the recent top, and then eventually the next big digital number, which is 30k, which is the next. I don't think it's met yet, which will be met soon. And then anything below, right, monthly and below, is gonna be extremely clear to read. All right, you know that we're gonna reach, or at the time this was happening, we already discussed this, right? That's the liquidity pool you would want to buy below. Now, the more extended the candle that took it is, the better. Which means the second we close below this low, this candle is automatically a range, and you want to be, or you want it to be swept into some sort of a level on the left. And now what makes it better is the level on the left is the gap that broke the high. And since it's the gap that broke the high, there's a absence of buy side delivered, sorry, sell side delivered here, from this line to this line, right? Now if I draw it correctly, it's gonna look like this. Alright? So this entirety thing, or this entire thing, really, this entire thing is a buy side, or sorry, it's a BC, correct? It's an FVG. If I draw it correctly, where we never delivered sell side, then you got a small portion in price, which is also a liquidity pool in the lower time frame, which is an existing FVG that will be tapped, which means long-term trades are found on this level. So if it's ever been reached, I'm looking for a high probability dual as a shift lower time frame, higher time frame key level, key candle, and then buying somewhere here. Or if not buying and you're looking for short-term bias trades, daily, weekly ranges, then you're looking for a candle of a bottom that we already discussed, and then higher prices. But if it's a false shift that will immediately get bought back up, then an explosion is going to be followed, which is exactly what happened, or what's happening right now. So level was never reached. Now, what you need to discuss, or what we need to discuss, is the follow-up delivery. So obviously, by the time you decide to buy, the candle is already going to break out. And now, at the time the candle breaks out, you're looking at a big digital number. And now you're thinking, is it going to be reached by an expansion or by a trend? Is it going to be reached like this, or is it going to be reached like this? Right? That's exactly what you're thinking of. Right? By the time this candle, the breakout candle, closes far away from the top, near the dole, then you're already suspecting an expansion, which means close above, higher prices, which means you're no longer paying attention to premium and discount. You're no longer paying attention to open, low, high, close. You're simply thinking of buying a candle, and that's it. If the candle's bias is bullish, you'll be thinking of buying the candle itself, and that's it. If you could somehow find an hourly liquidity pool taken below the open of a sorry, a 4-hour liquidity pool taken below the monthly open, that makes it even better. So now lower time frame only confirms what I'm saying, which is a straight expansion. The first time where the down close candle was formed, it acted as a range. And again, I don't care about premium or discount. I care about liquidity pools more than key levels. Yeah, more than key levels themselves, rather than dealing ranges. When it comes to expansion, I'm thinking about positioning myself in a lower time frame discount, higher time frame below the open, quote unquote, more than anything else. So the candle itself, or the down close candle in a bullish market, potential auto block, gap in a bullish market on a weekly, if an hourly liquidity pool is rejected here or below here, and an hourly high or high that took a low is broken after this level is reached, and preferably a daily CSD, right? That makes it even better. So the next idea that comes in mind is the daily liquidity pool that is a weekly inefficiency. That makes it even more better. Since we're trending on the daily and we're not expanding or expanding, then the only way for you to buy in deep premium a daily chart is for not is for a daily liquidity pool to be taken. For a swing play or for lower time frame play, the only way for you to buy safely is by waiting for a liquidity pool to be rejected or taken at least. You could immediately long here, but what you're gambling here is a high rejected. You're gambling a low being rejected as well. There could be a high rejected, a seasonal tendency, a low broken, short-term retracement, right? And then a fat decline into a quick explosion rally, continuing the expansion. But since we're in an expansion phase in every single chart I mentioned except the daily, then that is less likely to happen. So the low is rejected, and now we're a liquidity pool and a 15-minute liquidity pool or high that took a low broken. There is also a daily high and a daily CSD, and that's the highest probable candle to buy. Goes forward, and then eventually you got the liquidity pool's top never met. Instead, we got a high close here. So the weekly liquidity pool never met, which is a down close candle, which is a range high, right? Which is a failure swing in a bullish market, and you're buying towards it. That makes the candle number three, right? The candle number three makes it even high probable, right? With a set profile being week one, low month, OTE of week one, or 50% of week one, and then continuing on week four. So week one, pause week four, that we discussed before again. So then, eventually, what are you looking for to buy? There's an absence of any, so we're inside an existing range here. Then there's a open discussion of a breakout. All you're thinking of is buying any hourly liquidity pool or a 15-minute liquidity pool that's being dipped into. That's it. If that happens, then you got yourself a high probability trade hypothetically from here to here, and even the risk to reward will be extremely good, right? Into the top itself. So if that ever happens, then there's an entry. Instead, there is a rally immediately towards it. Now, does this stop the expansion? Absolutely not. This confirms the expansion with a Monday low week, right? So how you should be seeing it is Monday low week, then potentially Tuesday, Wednesday, and what is the safest way, quote unquote, to buy in premium to avoid being wrong and to buy above high and buy an all-time high and buy, I would say, in deeper premium, is if Tuesday closes and breaks out of Monday, and then you're expecting Monday, Tuesday, Wednesday, the same direction towards this line, right? But the next candle that will most likely be traded is Tuesday, which is an extremely high probability candle in my opinion, right? And as you can see, if you mark out the opening price of Tuesday, dip, liquidity pool, key level, and a rally. And it's very unlikely that this idea fails. I've been observing this since the morning, and even the reaction speaks itself, right? But until the outcome, if it does fail, then there's a there is a open discussion, like I said to Arman, of a longer term range. And if this not fail, or if this succeeds, then the level is or the level is far away from 30k, which means it's gonna exceed this line and move a lot more higher and form another expansion phase like this one, all depending on Tuesday's candle. Until that happens, you guys stay safe, observe Nas, and go back and refer back to 2025 where I spoke about its its seasonal tendencies. Alright? Be safe and peace, folks.